And we will be sharing the recording at the, we'll be sharing the recording link at the end of the session. We'll be sharing in the group, and who are not part of the group, I will be sharing that recording separately. We will be sharing a feedback form at the end of the session, so we can collect your email IDs. Then we will be sharing. We'll be sending the we will be sending the link, the recording link to you. At the either today or tomorrow, we will be sending the link so that you can watch it later as well. Okay. Today we are going to discuss an important topic: corporate tax in UAE. As we know, corporate tax is implemented in UAE from this year onwards, and every legal professional and the business should have a clear understanding of what is, and we should have complaints on the corporate tax. So it's a very relevant topic. And the speaker for today is a financial expert, Jayashree from Brahma Consulting. She's from Dubai. Let me give a brief about Jayashree. Jayashree is a financial expert based in Dubai. She started her career with the KPMG and then worked with Ernst & Young and GE in her career in finance. She's a chartered accountant from India and also a CPA from US, and has certificate in international treasury management from ACT, UK. Her span of professional experience includes audit, tax, finance, anti-money laundering, AML, planning, and treasury. She is the founder of Brahma Consulting based in Dubai. Brahma Consulting is a compliance and management consulting firm. The company focuses on the UAE VAT, corporate tax, ESR, AML, and other compliances. And the Brahma Consulting is also providing CFO services. I know Jayashree for the last 3 to 4 years, and she provided a valuable consulting service whenever we had issues in financial related things. Okay. For example, last month when I had some, we have a project in Saudi Arabia, and we had some challenges in doing the calculating the withhold tax, WHT. Okay, we are quite unaware of things. We are a software provider, legal software provider, and when we needed to when we do the billing, there are many components that say software license, implementation, training, data migration, support, and all. The WHT for each of these items are different. So it was quite a new knowledge for me. So she helped me to tackle the issue. So similarly, she's she's an expert in finance matters when it comes to finance. So thank you, Jayashree, for accepting our invitation, and it's over to you.
Thank you, Brajesh, for that very lovely introduction, and also most happy to support anywhere we can. And today's session, I'm excited to take this session because corporate tax is brand new for UAE and for businesses in UAE, which are extremely used to a very sort of compliance-free environment. They are now having to adjust and understand what compliance means, what laws are affecting their businesses. So having said that, I'm just sharing my screen now, and I know that most of you have a background either in the law or you're working in the sphere of legal environment, so you understand that how laws can be quite how do you say that it has several parts to it. So for instance, we are looking at the corporate tax law, which has been released in UAE in December this year, which is going live in December last year, and which is going live in June this year. I'm sorry, it says 2022. But the fact of the matter is that there are still several parts of the law which have to be released. Yeah. So what we are talking about today is the law that's already been released, and we will. So there is the first. I'll give you a brief history of how this has progressed. First, the public consultation document was released last year. The public consultation document gave an overview of what the corporate tax is going to look like in UAE. After that, the law itself was released in December, but in December of 2022, they mentioned that it's going to be supported by several executive regulations and cabinet decisions. So what we are trying to go through today is subject to those cabinet decisions, which will be released during the course of 2023. So this is the agenda for today. And Brijesh, I shall start the presentation then. I mean, I guess more people may join as the,
yes, you can. And people are joining, but you can start it.
I will start off. Yeah. Okay. Cool. So we'll briefly talk about. We'll give you an introduction to corporate tax. We'll talk about who is being subjected to corporate tax, or CT for short, the basis of taxation, some terminologies in corporate tax, which will become an everyday word for you. Now that you're all getting exposed to, you're being subjected to, your business is being subjected to corporate tax, you will hear a lot of these terminologies, and you will understand that as you have a business in UAE, as you're opening a new business in UAE, or you're having clients in UAE who are doing business, and you will understand that what areas are important to consider, whether it's the structure, the way you're setting up the company, or whether it's the transactions that companies are having with each other. So you will start thinking about, just the way I'm sure you thought about it for VAT. 2018, prior to that, nobody was charging VAT. There was no law. And there was no understanding of having books of accounts or charging, having a tax invoice, etc. And now everybody is way more familiar. They understand the importance. They understand their obligations. Similar to that, there are several terminologies you will get accustomed to, familiar to, and we are trying to address those very important, high level, yet very important areas in corporate tax today. And we jump into the introduction. And as you all may be aware, that the corporate tax goes officially live on 1st June 2023 this year. And the reason that UAE is going ahead and implementing the corporate tax is obviously because it's and this is a government, how do you call it, release, right? They say that it's because they want to achieve their strategic objectives and also accelerate its development and transformation. In other words, what they're really saying is that UAE wants to compete with the London and the Singapore and the other financial centers in the world, and want to be seen as not as a tax haven, not as a country where companies come to save taxes. They want companies to come here to be, because they are the financial center. They are the country where businesses can really compete at a pretty standard, good regulatory practices. There's money is, it's not, so to speak, laundered money, etc. And so that kind of reputational change UAE wants to bring about. Its commitment is very strong, and they have made a lot of commitments to an organization called OECD. So as part of that, they have released the corporate tax. Actually, as part of that, they were also quite, that was also quite instrumental to the releasing of the VAT. Now almost 5 years back. And they've also released the economic substance regulation, which I'm sure you're familiar with, which was released in 2019, then subsequently amended. Then you must have heard of the anti-money laundering law, and so forth. So several regulatory releases have happened on account of UAE's commitment to be seen as a tax transparent, as a country with a very good reputation, on the international level. So that is the intention of implementation. And I've given a brief snapshot of the areas that is of interest, right? Now, if you're a business running a business, or if you have a client who has a business, you want to be able to give them some quick answers on their basic queries on corporate tax. And the first one is, what's the corporate tax rate? So you may have already heard that there is such a thing as a taxable income. A taxable income is basically, unlike VAT, this is not your revenue. This is your revenue less allowable expenses. So basically your profit. Now, a business profit may not be taken as it is for tax. It's called adjustment for taxable profits. So you may have to do some adjustments. And we will talk at length later on, but this is where it becomes very important for businesses to be more conversant, more understanding of the laws in the land. What does it mean? Now you have to know what's your taxable income. We come across businesses, and I'm talking about fairly substantial businesses which have been around for a while, not maintaining proper books of accounts. If that is the situation, how would you be able to prove to the Federal Tax Authority what is your taxable income? First, you need to have books of accounts where you're able to compute your revenue, where you're properly captured your expenses, and hence arrive at a business profit. Then you make the adjustments which the tax allows to arrive at a taxable profit or a taxable income. So say for your financial year, your taxable income is 400,000 dirhams. So for the first 375,000 dirhams, you don't have to pay any taxes. For the remaining 25,000 dirhams, you do have to pay taxes at 9%. So that is essentially what the tax means to your business. You pay to the government on your profits a certain amount of tax. Now, there is this whole lot of discussion on what if we are a free zone company and we're not registered on mainland. We were the whole point of free zone should be that we are not being subjected to tax. But unfortunately, it's not so straightforward. And there's a lot more, let's say, complexities involved in understanding who is allowed 0% benefit, who will have to be paying the sort of regular taxes. So they have provided something called a free zone person. They have defined who's a free zone person. And if your company qualifies for that free zone person, you could go for the 0%. And so if you qualify as a free zone person, you could avail a 0% tax on your qualifying income. So again, you would need to prove that what is your income in a year, and according to that, you calculate. So again, it comes back very essentially to be able to maintain your books of accounts. And I say books of accounts and makes it sound like it's one big task, but really speaking, it's about when you're invoicing your customers, make sure you have a proper and organized way of keeping your records. And then they are calling another interesting feature that they have in free zones is now that they're calling it a qualifying income and a non-qualifying income. And the income that does not qualify, they have said it's 9% taxes. So if you see, it's interesting that for that not qualifying income, they do not have that level of 375. So it looks like, at least, unless there's some clarification issued, that the 9% will be applicable outright on all the income and there won't be a 375 threshold. Again, we are talking about what is based on the information released so far. There are still a lot of cabinet decisions that need to be released. So some of this information may change. Now, if you see, I've put an asterisk again, 375,000, and that's because in the law per se, they have not mentioned the threshold after which the tax will be applicable. They have said that it's subject to confirmation in the cabinet decision. So we will have to await the cabinet decision to define the 375,000. Though it should be 375,000 because the public consultation document mentions that amount, and also the FAQ on the corporate tax website states that amount on the website of Ministry of Finance. There's another interesting addition that is there in the corporate tax law, which I thought would be of interest to you, is what they are calling a small business relief. They have said that they, being the law, says that a small business may elect to be treated as not having derived taxable income for a tax period. This election is subject to a revenue threshold and other requirements to be set out in the cabinet decision. Again, so it's subject to further release of executive regulations or cabinet decisions that the government will soon release. As I proceed with the presentation, in case if you have questions, I typically am perfectly fine with if you write those questions on the chat, as and when, if I'm able to get to it, I can get to it and answer it then and there, or we can get to it at the end of the session. Yeah. So going on to the further talking about the corporate tax, this is actually an image from the ministry website itself. What's interesting to see is that how is the financial year, of course, is defined, but also the period of registration that they talk about. So according to the government, if you see on the first half, on the top half of the page, they've said that, so 1st June 2023, the law will go live. And say you are a company with a financial year that runs June to May. While that's a bit unusual, normally companies don't run from the middle of the year to the middle of the next year as a financial year. But say it is, for whatever reason, you have a company that has a financial year of June to May. Then because the law goes live on 1st June 2023, 1 year on, till 31st May 2024 is the first financial year when you will have to track what is your taxable income, and based on that taxable income, pay your corporate tax on that. You have 9 months after the 31st May 2024 to pay your taxes. Not only pay your taxes in that 9 months, you have to also file a return. Like you have been, I'm sure in your business, you've been filing VAT returns, and you have been also been paying VAT before the filing of the return, similar to that. Except the only difference is that here the return is filed annually, as opposed to normal VAT returns are monthly or quarterly. And another distinction is that this is going to go live only well into, we are talking about from now, you've got 12 months, another 12 months, and then, which is when it's going to really go live for you. Now, we will further talk about what is the registration, etc., in subsequent pages. I'll just quickly take you through the second half of the page, the bottom half, which talks about what if you have the more common financial year, which is Jan to December. So the law goes live on June 2023, the law goes live, but your financial year is still ongoing. The 2023 Jan to December is ongoing, so that does not get impacted. They are saying only the financial period that starts after the law has been put into place. The financial period that will start after the law has been put in place is the 1st Jan 2024 financial year. So from Jan to December 2024, you shall be subject to corporate tax. You shall be filing within 9 months after that financial year, your tax return and your payment of taxes shall be done. Some key metrics which is good to know for a business. All taxable persons, that includes free zone persons, will be required to register for corporate tax and obtain a corporate tax registration number. Now, in VAT, value-added tax, you were being subjected to VAT, first of all, or rather you were applying for registration only after you reached a certain revenue threshold. It could be the voluntary threshold of 187,500 or the mandatory of 375,000 dirhams. Over here, however, it appears again, and we are awaiting further cabinet decisions to confirm this, that all taxable persons have to register irrespective of what their revenue or taxable income is. Again, this is subject to confirmation. And the Federal Tax Authority, the FTA, also have, so the Federal Tax Authority is the authority that really administers, manages the corporate tax, yeah? So they are part of the Ministry of Finance. So the FTA may also request certain exempt persons to register for corporate tax. We will go through who are the exempt persons under the law. And taxable persons are required to file a corporate tax return for each period within 9 months from the end of the relevant period. We just talked about it in the previous slides. And the same deadline would generally apply for the payment of any corporate tax due in respect of the tax period for which a return is filed. Okay, now we'll quickly talk about who will be subject to UAE corporate tax. Quite simply, a taxable person shall either be a resident person or a non-resident person, including a natural person. So here they haven't just said that if you have a trade license, you have a business that's running, you'll be subject to corporate tax. There can be several more categories of businesses which can be subject to corporate tax. For example, a non-resident person, including a natural person, yeah. And then also a branch of a taxable person is considered same as a taxable person. Now, who are the exempt persons? Typically, it's obviously the government entities, federal entities, emirate level entities, who are obviously running more, their agenda is to serve the country, etc. They are exempt. However, if a government entity is properly running a business, it has a trade license to maybe run a mall or a retail center, etc., they will not be considered an exempt person. Extractive and non-extractive natural resource businesses, because both extractive and non-extractive natural resource businesses have their own category of taxation and emirate level. They are not being captured under the corporate tax law. Qualifying public benefit entity. Now, qualifying public benefit entity refers to, and this will be clarified in a cabinet decision, which would be those entities. They shall also be exempt from corporate tax law. Qualifying investment fund. Now, this is an interesting exemption, very important to fully understand. If you are a regulated investment fund, carrying on investment fund business in UAE, do you qualify to be exempt for corporate tax. This is a very good benefit that's available to such businesses, and therefore they must closely review the nature of their activity, the kind of trade license they have, etc. Does it meet the criteria to be able to avail this exemption? Pension or social security fund, juridical person incorporated in the UAE that is wholly owned and controlled by an exempt person is also exempt from corporate tax. I hope you can hear me, Brijesh. Yeah.
Yes, we are following. Yeah, it's good.
Right. So I hope it's not too technical, but really speaking, this is like the bare basics that we all should know, and that's what we have tried to, focus on. Here, what I'm trying to focus on is the basis of taxation. Now, anybody who is going to be taxed, they first need to know that first, of course, they will see whether they are exempt or not. But then if you're going to be considered as a taxable person, under which category? Are you resident? Are you non-resident, etc.? And what is your tax base? Which part of your income is going to get taxed? Fairly open definition over here. For resident, an entity that's incorporated in the UAE, including a free zone entity, is considered to be part of the taxable person. A foreign entity that is effectively managed and controlled in the UAE. Now here they've left it a bit open, and there's not enough guidance. So this gives a whole lot of interpretation that needs to be done in terms of understanding whether an entity which is not registered in UAE, is it effectively managed and controlled in the UAE? Should it be taxed over here? An actual person, individual who conducts a business activity in the UAE, all these categories of people, their worldwide income will be taxed over here. There is, of course, a possibility of taking tax credits for taxes paid in another country, etc. There's a whole lot of that literature, but we have not covered that. But yes, so simply put, the worldwide income will be taxed in UAE. Non-resident is someone who's not a resident. That's how it's simply stated in the law. And non-resident is someone who has a permanent establishment in the UAE. Now, permanent establishment is again a terminology which you will often hear, and it's a very important terminology in the tax world. It applies for double taxation avoidance agreements. It applies for corporate tax. It of course applies for withholding taxes, etc. So permanent establishment, and it applies for transfer pricing as well. So permanent establishment, a very important concept to understand for businesses, because if they have a PE in a country, they might end up paying taxes in that country. So a non-resident has a permanent establishment in the UAE, would have to pay taxes, derives UAE source income. That kind of a person is considered non-resident, has a nexus in the UAE. Now, the last one has a nexus in the UAE, literally means has connection in the UAE, but they have to give us more information on this particular area in the law. Or rather in the cabinet decisions that's soon to follow. Now, just spent a couple of minutes talking about permanent establishment, because as I mentioned, it's very important to understand when you're setting up a business in UAE, please be mindful of these. This will help you plan your taxes. Now, it's no more a UAE where you come and set up any form of business, and there are no costs associated from a tax point of view or regulatory compliance point of view. Now it makes more sense to understand, is there any tax planning that can be done? It could be in terms of the ownership, it could be in terms of the transactions that you undertake. So, and the kind of transactions, with who do you undertake the transactions, etc. So it's important to understand those aspects. Now, what's a PE? What's a permanent establishment? If an entity has a fixed or permanent place in the UAE through which the business of a non-resident person or any part thereof is conducted. So it could be a factory, a warehouse, an office, etc. Yeah, or where a person has and habitually exercises an authority to conduct a business or business activity in the state on behalf of the non-resident person. For example, we came across the other day a situation where a person has literally set up a company here to do the marketing for MENA, for a US-based company, and that's all he's doing. There's only one contract he has. And so to speak, that he's really an employee of the US company, but since they do not have him on the payroll, they have set up the company just to do that. So if you look at that, he's really acting on behalf of the non-resident person. So what is his status then? Tax status, yeah. And then a PE can be treated where the non-resident person has any other form of nexus in the UAE as specified through a subsequent cabinet decision. That's what I mentioned. Now, this makes it a very open area, which means that we will really need to understand what connections are they talking about, which companies and people may have in the UAE, which would get captured under a permanent establishment. What is not considered a permanent establishment? If entity is used solely for conducting activities of a preparatory or auxiliary nature, very important to understand. So it could be like a marketing, purely you're just displaying, there is no processing required, there is no any kind of value addition happening. So those kind of very high level functions are being left out of the scope of PE. It could be something like what you, which is a fairly popular format of having liaison offices. People have fairly large LOs incurring large expenses, which hardly make any revenue, and their primary presence in the country is more to, create contacts, have meetings, etc. So they may not be considered as a PE. And another interesting one, which will again be, causing a lot of discussions and interpretations for us tax consultants, is the law does not make any reference to services PE. So what happens when companies are here providing services? How do we establish whether they are a PE or not? But we hope that in the cabinet decision, it may be clarified. All right. So this is, again, of course, of great interest for businesses in UAE. What is the tax applicability to free zone persons, free zone companies? Now, we have provided to you information that is in the law right now. Please be mindful that the cabinet decisions will further clarify what a free zone person would be able to do in terms of managing their taxes. Now, companies and branches registered in a free zone are considered taxable persons under the corporate tax law and are required to meet normal compliance obligations, including transfer pricing requirements. Now, this last portion of the sentence, including transfer pricing requirements, again, is a very key terminology, transfer pricing. And we have a few slides today to talk about that. It's not a scary term. It's not a term that, you need to feel that I don't understand what it is, and hence I don't know what to do about it. It's a fairly logical approach to business. All the government wants from businesses is that, be it a free zone company, be it a mainland company, if you have transactions with parties which are related to your company, have them at arm's length. Have them as though you're having it with a third party. That's very simply put what transfer pricing means. So it is fairly common to see, not anymore, because with all these efforts by OECD and by international tax bodies, one of the popular tax planning methodologies was to open a company in a country which was tax-free or very low tax base, and then transfer all your revenue to that country from a very high tax country, say India or UK or US, or just name any country which has a pretty deep history of corporate taxes. And so what they would do is they would open a company in a country which has a low tax base or no tax base. And then what do? You transfer your taxes there, your revenue there, or your expenses there, depending on how do you want to manage the taxes from where you're transferring it. So this led to clearly, questioning these transactions between related parties. Are they at arm's length? Are they selling to the company that they have opened in this low tax based country at the same price? Or are they charging the same? Is it the same cost had it been to a third party? So that's where transfer pricing came into being. That's where, the obligation for companies to justify their pricing, etc., happened. So that was a brief sort of, highlight on why free zone companies need to be careful when they're dealing with related parties. And we will talk about what's a related party as well. Qualifying free zone, important terminology, qualifying free zone. Yeah. So we will see what a qualified free zone person is eligible for a 0% UAE corporate tax rate on its qualifying income. So qualifying free zone person maintains adequate substance in the UAE, derives qualifying income. This qualifying income will be defined in the cabinet decision, not have made an election to be subject to the standard UAE CT regime. Standard UAE CT regime is the 9% above 375. comply with all transfer pricing rules and documentation requirements, and meets any other conditions as prescribed in the Ministry of Finance. Sorry. Okay, so just to sort of summarize, what are the areas that are still awaiting cabinet decision? Definition of qualifying income, treatment of transactions between free zone entities and related unrelated entities and branches in mainland UAE. What does adequate substance in the UAE mean for a free zone person? So these are areas which we are curious to see, obviously, because that's when we can understand whether a free zone person benefits by electing to, go for this qualifying income and being a free zone person, or they might as well just pay 9% on above 375. So we need to know all this information. Any additional conditions that may be set by a cabinet decision, and based on the public consultation document, the PCD, qualifying income definition looks like would include income derived from outside of the UAE and within free zones. So as I mentioned, that the government had released a public consultation document last year, and they had talked about what income in the free zone would be not subject to tax. And it talked about income that's derived within free zone, within the free zone, with other free zones, or outside of the UAE. We believe it may be a similar kind of definition once the definition is released in the cabinet decision of what is a qualifying income. All right, now we are talking about, and this is a bit sort of accounting, but it will be good for you to know at least the key highlights. You may not be the accountant in your business, you may not be leading the finance in your business, but this is good to understand. Firstly, the tax is a self-assessment tax, which means that there is nobody going to come, or there is no software out there which the government will release. It's for you to compute your own taxes. So it's called a self-assessment basis. So it's quite a normal way to go about computing taxes. There is no advance tax payable. Now, in India, it's very common for companies to pay advance taxes. So for a financial year, every quarter, they will already be estimating what's going to be the profit or loss and paying taxes. And at the end of the year, they will adjust it against the actuals. But there is no such complication here, which makes it very, very easy administratively for the companies, because literally all you're expected to do as a company is maintain your financial statements, maintain your books of records, make the financial statements. And at the end of the year, for that year, you can compute your taxable income, the profits, and then pay your taxes. So they have really simplified the administration part. Taxable income is calculated from the accounting profit loss as per the financial statements. Financial statements to be prepared in accordance with the accounting standards. Option for preparation of accounts on cash basis. Specified adjustments to the taxable income is prescribed. We will talk about that a little bit. When accounts are prepared on accrual basis, assets and liabilities to be considered at fair value on impairment basis and unrealized gains and losses. So there will be a requirement to follow your accounting standards. It could be, normally speaking, the IFRS. So please ensure, and this is not, again, something very complicated or rocket science, if you may. It's a fairly prevalent way of accounting, so it can be done. And if that is being followed, it makes it all the more easier. From the taxable income, the deductible expenses are your legitimate business expenses incurred wholly and exclusively for the purpose of deriving that taxable income. Timing of the deduction may vary for different types of expenses and accounting methods applied. So this will be, of course, defined in the cabinet decisions. For capital assets, expenditure would generally be recognized by way of depreciation or amortization deductions over the economic life of the asset. Expenditures that have a dual purpose, such as incurred for both personal and business purpose, will need to be apportioned. Now, normally speaking, it's quite prevalent to have books of accounts specifically for tax. I think somebody needs to go on mute. Thank you. Satya, can you go on mute, please? I'm not sure who it is. Okay, so normally it's quite normal to have to close your financial books, and then what you do is like a tax walk. You start walking that income that you have arrived at in your financial books to the taxable income, which means the depreciation probably as described in the tax law may be different from the depreciation that you went for in the IFRS. So you may have to do that adjustment. It could be some kind of impairment that you did, etc. So there may be some adjustments that you do in the tax books, which is different from your financial books. So that kind of adjustment happen, and it's quite common. So you would need to maintain. Somebody needs to go on mute. Thank you. All right. So a little bit more diving into the deductible expenses and what's not allowed. Clearly, any kind of penalties, fines paid to the government, donation grants which are not made to the qualifying public entity, dividends not allowed. Please note, dividends are not allowed. Expenditure not incurred wholly and exclusively for the business is also not allowed. The government is allowing client entertainment expenditure up to 50%. And interest expenditure up to 30% of the amount of EBITDA. Again, I've given very high level. When we actually get down to it, there may be more details which we have to consider. Tax groups. We thought it'll be good to mention about tax groups because this may help you in your tax planning. If you have several companies in UAE and they have a lot of intercompany transactions because of the way your company is structured. So it's good to know what tax groups saves you on the taxes, saves you on the administration, etc. Yeah, so tax group is basically 2 or more taxable persons can apply to form a tax group and be treated as a single taxable person for the purposes of corporate tax. And when can you form a tax group? When both the parent company and subsidiaries are resident juridical persons. Juridical is basically registered here in UAE, have the same financial year and prepare the financial statements using the same accounting standards, say IFRS. For instance. Additionally, to form a tax group, the parent company must own at least 95% of the shares, 95% of the voting rights, and is entitled to 95% of the subsidiaries' profits and net assets. So the ownership rights and entitlement can be held either directly or indirectly through subsidiaries, but a tax group cannot include a qualifying free zone person or an exempt person. So because clearly you cannot have advantage of both. You take an advantage of being exempt and also you take advantage of being part of the tax group either. Withholding tax. So the good thing is UAE still continues to have zero withholding tax, which means that, for instance, if there is any vendor you have outside UAE, you can pay them the full amount. You don't need to hold any of their payments, which means that there's literally no filing to be done or any kind of, obligations for you in terms of withholding taxes. Because of the 0% rate in practice, no withholding tax would be due and there'd be no withholding tax related registration and filing, which is a relief, obviously, for all of us. Withholding tax does not apply to transactions between companies or entities within UAE. All right, now we come to the transfer pricing. And I think it's important that all businesses, owners, the CFOs, of course, and the operations leaders, etc., understand the importance of transfer pricing now that it's gone live, it's a reality for us. And I've not delved too deep because, one could go on and spend quite reams of slides talking about transfer pricing, but high level to give you an understanding so that you don't, when you come across this terminology or when you are talking in your business, you're able to make some sound sort of, decisions. So transfer pricing rules seek to ensure that transactions between related parties are carried on at arm's length terms, as if the transaction was carried between independent parties. To prevent the manipulation of taxable income, various articles in the corporate tax law require that the consideration of transactions between related parties and connected persons need to be determined by the reference to their market value. Seems logical, right? So if it is transactions with related parties, and we'll define what is related parties and connected persons, these are 2 different terminologies in the law. They have said that it needs to be made with reference to the market value. And transfer pricing rules apply to UAE businesses that have transactions with related party and connected persons, irrespective of whether that party is located in UAE, a free zone, or outside UAE. Now, what's a related party? Pretty much, it really captures a wide gamut of people and companies, so it's not easy to escape that. 2 or more natural persons related up to 4th degree of kinship. So 4th degree means parent, grandparent, great-grandparent, son, so forth, or daughter, and then you go on grandson, granddaughter, so forth. We are looking at 4th degree of kinship, and hence sometimes it's even difficult to know that, okay, maybe he or she is not, I didn't even know they were in the 4th degree of kinship, right? So there is, that's where disclosure or rather disclaimers and, KYCs, etc., become very important to understand who you're dealing with. A natural person and a juridical person related by ownership of 50% or more. So if it's 2 or more natural persons, it's 4th degree. If it's a natural person and a company, it's 50% or more. 2 or more companies, then it's related by 50% or more ownership or control. And a person and its PE or foreign PE or partners in the same, so PE and a person is considered a related party, partners in the same unincorporated partnership, trustee, founder, settler, beneficiary of a trust or foundation and its related parties. Now, control. What does control mean? 50% or more voting rights, determines the composition of 50% or more of the board of directors, receives 50% more of profits, exercise significant influence. Now, now in tax laws, we are very particular about, usage of words such as significant influence, substance, and control and effectively controlled, etc. We need to know so that we can interpret it and apply it to companies, but we are still looking to see if we will get the clarification on what is significant influence. Otherwise, we use closest other laws that may help us. So I talked about 2 kinds of if you may, parties. They're looking at related parties and connected persons. Connected persons sort of casts the net even wider, and it includes a natural person who directly or indirectly owns an ownership interest or controls a taxable person or a director or an officer of the taxable person. And partners in the same unincorporated partnership or related parties in any of the above. So the last line pretty much again throws the net further away and captures more people with the director and officer of the company. Transfer pricing methodology. So how do you determine what's the arm's length pricing? What is the market value? So there's a lot of literature around that. Lot of, be it UN, be it OECD, be it the BEPS, and which is within OECD, they have a lot of guidance on that, on which methodology you can use. How does that methodology work? But I have mentioned here 5, which is actually mentioned in the UAE corporate tax law. So any one of these can be used to determine your arm's length values for transfer pricing. There is the comparable and uncontrolled price method, also called the CUP method, the resale price method, the cost plus method, the transactional net margin method, the transaction profit split method, depending upon the kind of transactions you have between related parties. Choose one of these. So for instance, if you are in the business of selling or exporting some kind of retail product, but you're selling it on a wholesale basis, you could see someone else in the market who is selling it and to a similar country, so all the conditions and environments should be similar. It should be similar product, similar country, and then, the quality of product, etc., so that you can arrive at a suitable arm's length price. What does the business have to do, right? What do they have to? They will be required to maintain information regarding their transactions with related parties and connected persons. And certain businesses will be required to submit this information along with their tax return. We believe those certain businesses would be free zone persons. Businesses that claim small business relief will not have to comply with transfer pricing documentation. So that's a true relief for them. Certain businesses may be requested to maintain a master file and a local file. This is very typical terminology for transfer pricing transactions. So that's pretty much what we have covered today. And I think, that's sort of what we were hoping to cover. If you have any questions at this point, I'm more than happy to take it. And I'll just check if there's anything on the chat. No, nothing. Right. So feel free to ask any questions at this point. And a few things I would like to highlight. Corporate tax is going to be a reality from June this year. But if you are a company which hasn't defined a financial year, you could define your financial year as Jan to December. Therefore, you will become corporate tax will become applicable to you from 1st Jan next year, 2024. And then you will start maintaining your books of accounts according to, so that you're able to follow the accounting standards, etc. And you pay taxes in 2025. Please watch out for the cabinet decisions, which will support this law, because that will make a big difference in understanding which free zone companies are covered, how can free zone companies opt for the 0%, what kind of formalities they have to follow to be able to maintain the 0%. And finally, one more point I want to mention is that say your company follows the Jan to December financial year, and you're going to have corporate tax applicable to your business from Jan 2024. It doesn't sort of show a trend if you suddenly start expensing off any kind of, it could be a salary or it could be any other kind of expense which you have not claimed as an expense before. It's good to have a books of accounts which shows a trend where there is a normalcy, where you're able to establish that we have always operated like this. Our profits are X this year. Next year, obviously, our revenue has gone up by X plus 10. Profits have gone up by X plus 8 or something. So that gives a lot of assurance to the, the authorities that the books are being maintained properly, logically. So to that extent, it makes sense that have a simple software which captures your books of accounts right away. You probably already have, but I still think it's worthwhile to mention. And make sure you understand what kind of expenses you're booking, how's your revenue getting booked. Look at it right away so that you can see that what kind of expense you're looking on account of tax next year. So yeah, those are the really important areas I wanted to highlight. If anyone has any questions.
Thank you, Jayashree. A lot of learning in a short time.
Thank you.
Before we go to the Q&A session, we are doing a recording of the session, and a lot of valuable information are there. And if you want to receive this, recording by email, we will be sharing a feedback form. So you can put your email ID so that we will be sharing with you.
So this is
my. Share the form. Yeah.
Oh. You want me to share my email?
Yeah, of course, you can share your contact details, definitely. I mean, if you want to share our this recording, for the attendees, we are sharing a form. So the form link. So in that form, Riska, we will be sharing a form. Purna will be sharing a form right now. So you can fill that your email ID in that form, so that we can it will be easy for us to distribute. If you have got any questions, you can ask.
I think the crowd followed everything.
Yeah, you can unmute yourself. You can unmute yourself and ask. Is it okay, right? I mean,
yes, of course. Please go ahead and ask. If I'm able to answer, I'll be happy to answer that. One other thing I wanted to mention that I'm not sure how many lawyers are here. Are there lawyers here, Brijesh, or mostly IT sort of?
95% are lawyers here.
Lawyers, right?
Lawyers, in-house legal counsels, and even law students are there from UAE and outside UAE as well.
Right. So just wanted to mention that the other area that is of very significant importance for lawyers is the anti-money law, anti-money laundering law. So that's also something they should be very, I'm sure you're all already aware of it, right? Because of the screening that you have to do. And because it's a lawyer gathering, I thought I should mention it that as you're a designated non-financial business and profession, I'm sure you're already sort of aware of your obligations. So that's an area also which really impacts lawyers. right, so I'll just stop sharing my screen. So the form is for the audience to fill out, right, Brajesh? So. You're on mute, Brajesh.
Yes, if you want to receive your video recording, you can share your email ID in that form. So it will be easy for us to share that. Okay, we have got 3 minutes. And if you have any questions, you can share it now. It's a good opportunity for all of us to get our queries answered from a subject matter expert. He's in front of us, so please feel to ask. Otherwise, we can wind up the session. We'll wait for a few seconds. You can unmute yourself and ask any questions.
Yeah, I've also submitted the form. It'll be good to receive the recording.
Okay.